Welcome back to The Explainer. Today we are diving into a really radical idea about investing. It's one that isn't inspired by Wall Street at all, but by the principles of evolution. All coming from Pulak Prasad's fantastic book, What I Learned About Investing from Darwin.
All right, let's just kick things off with a number. And honestly, it should probably shock you. 90%.
So what is that? Well, that's the percentage of professional fund managers, the people with the elite MBAs, the ones managing trillions of our dollars, who over 2 whole decades failed to even match the market. We're talking 9 out of every 10.
Now, the author of our source material, who's a successful fund manager himself, he really doesn't pull any punches. So, if the pros are getting it so wrong by their own admission, where are the rest of us supposed to look for a better way?
And this brings us to a pretty wild idea. What if the best investment principles don't come from business school at all, but from the 3.8 billion-year-old proving ground of Darwinian evolution?
So, what's the single most important lesson we can take from the natural world? It's not about being the strongest or the fastest. It's all about being the safest. It's about surviving long enough to actually win the game.
In investing, and really in all of life, there are fundamentally 2 types of mistakes you can make. The first one is called a type 1 error. That's an error of commission, doing something you shouldn't have, like investing in a really bad company. The second one is a type 2 error. That's an error of omission, not doing something you should have, like passing on what turns out to be a great investment. The key question is, which one is more dangerous?
To understand the answer, evolution gives us a perfect example. Let's just picture a deer at a watering hole. Every single time it goes for a drink, it's facing a critical life-or-death decision.
If that deer makes a type 1 error, it approaches the water thinking it's safe, but a predator is hiding, the result is catastrophic. It's death. Game over. But if it makes a type 2 error, it's too cautious, gets spooked, and skips a drink at a perfectly safe spot, the result is just an inconvenience. It gets thirsty. Nature has brutally and efficiently programmed that deer to avoid the fatal error at all costs. It prioritizes survival above everything else.
You know what? This is the exact same survival logic behind Warren Buffett's famous rules. It's not a command to never make a mistake. It's a command to obsessively avoid the catastrophic mistake. It's all about thinking risk first, not returns first.
So, how can we apply this whole survival-first mindset in the real world? The author suggests a checklist, but it's not about things to look for. It's a checklist of things to aggressively reject. The argument is that being a great investor isn't about being a great stock picker. It's about being a great rejecter. It means systematically filtering out all those situations where the risk of one of those catastrophic type I errors is just unacceptably high.
Let's just take turnarounds, for example. The stories are so seductive, but they're almost impossible to predict. Back in 1993, IBM brought in an executive from a biscuit company to save their dying tech firm. Seemed absolutely absurd, right? Yet the stock soared. Then, in 2011, JCPenney hired a retail superstar from Apple, a perfect fit on paper, and the result was a complete and total wipeout for investors. The risk of a fatal error is just way too high.
And the same logic applies to debt. Debt is basically the financial version of that predator hiding by the watering hole. It just removes your margin for error. A company with a ton of cash, like Asian Paints, was actually able to increase salaries during the 2020 lockdown. That built immense goodwill, all while its indebted competitors were just struggling to survive.
And what about CEOs who are M&A junkies, just constantly buying other companies? Well, the data is brutal. Study after study shows that somewhere between 70 and 90% of mergers and acquisitions fail to create any value for shareholders. It is a game with absolutely terrible odds. But the crucial point here is that the real cost isn't just the money they spent, it's the opportunity cost. It's all the good things that didn't happen. Look at Bayer's disastrous $63 billion acquisition of Monsanto. Sure, the lawsuits were bad, but the invisible cost was even worse. The distraction and debt likely prevented them from creating a COVID-19 vaccine, which was a multi-billion-dollar opportunity their competitors seized.
Now, it is really important to understand that this intensely strict, risk-averse approach, it comes with a very real and pretty significant trade-off. Following this checklist means you will have to be completely comfortable watching some rockets take off without you. You would have passed on Tesla because of its debt and cash burn in a rapidly changing industry. You would have had to reject Eicher Motors in India because it was a classic, high-risk turnaround story.
But the philosophy argues that this is a price worth paying.
Because for every one Tesla or iShare that you miss, you have successfully avoided hundreds of similar companies that went to zero. You're trading that small chance of a spectacular win for the high certainty of survival.
A really simple experiment with bumblebees illustrates this whole concept just perfectly. So, scientists set up an artificial garden where some of the flowers had hidden robotic spiders that would briefly and harmlessly just grab any bee that visited.
And the bees learned incredibly fast. They not only started avoiding the dangerous flowers, they began avoiding the perfectly safe flowers right next to them, just in case. They willingly gave up nectar, an error of omission, to completely eliminate the risk of being caught, a potential error of commission. They literally chose to be less efficient in order to guarantee their survival.
And that really leaves us with a final, provocative thought. In a world that pushes us to chase every opportunity and maximize every single return, maybe the most successful long-term strategy is the one perfected by nature over millions of years. Focus, first and foremost, on not getting killed. If the bumblebee can do it, why can't we?